Welcome to the Passive Income MD podcast, where we talk about creating your ideal life through multiple streams of income. If you enjoy hearing about this stuff, make sure to hit subscribe. Now let's get on with the show.
Hey everyone, I'm excited to talk to our next guest is Dan Peck. He is a senior loan officer at Movement Mortgage. I always have questions about lending, financing. I'm sure a lot of people listening to this have questions about it too, about what the current market is like, actually how to get favorable rates or what kind of better loans they can get, and also maybe even some creative strategies, whether you're buying something residential or maybe even something like an investment property. And I thought, who better than to bring on a good friend of mine, Dan Peck. Again, he's at Movement Mortgage, has over 25 years in this space. And he's probably done over 10,000 loans. I think he's forgotten. I mean, he's lost count. It's been so many people. And again, he's works with so many physicians in our community. And again, it's super approachable. And so I'm just excited to talk to him today about lending and financing today. Dan, how you doing?
I'm doing great, Peter. Thanks for having me.
I tried to do you justice to the intro, but I don't think I did. So do you mind just sharing a little bit more about yourself and tell us a little bit about like what you do?
Yeah, no problem at all. Like you said, I've got over 25 years in this lovely space of the lending industry. Started back in 1997. Actually started doing this when I was in college. I did an internship with a mortgage company and just kind of never left. I did leave briefly for about 3 months to graduate and then went back. So really been doing it ever since. So obviously, if you go back to 1997 and project forward to today, we've had lots of different market cycles and seen a lot of different things in the real estate market. So that's given me a lot of experience. My life is pretty full. I've been married to the same lady for 25 years, met her at college as well. We have 2 kids, 19 and 17. So they are vastly growing into their own shoes and getting out into the world and doing their own thing right now. Other than that, I've been at Movement Mortgage for about 3 years now. We came over here after being at another company that had gotten purchased and bought out. And that company just was really not wanting to stay in the retail lending space. They really wanted the servicing portfolio. So we moved over to Movement, and it's been nothing but a great thing ever since. So it's actually one of the largest and biggest portfolio lenders in the country. And so it's been really beneficial to all of my clients that we've been here.
I mean, it's incredible, the background experience. And one thing you talked about is, you've been in this space for a long time. And you mentioned that you've been through a lot of market cycles. And, for some of us that are looking to buy homes, we're in, we're out. We don't necessarily see all the ups and downs, but we probably hear about it on the news. And so obviously this period, we've heard a lot about interest rates, and a lot of times we're waiting from the Fed for different things to happen. But where would you say, when you look at kind of over the past 25 years and you've seen these cycles, tell us where we are right now and kind of give us your perspective, like thinking macro, like through all the cycles. Is this like a normal place we're at right now? And what's your take on it?
My take on the market right now is it's a great time to buy. I mean, I know that rates feel like they're high, but again, if you roll back in time, depending on how old that you are, if you go back into the mid 2000s, rates were in the 6 to 7% range, which is where they're currently at right now. And, things were humming along. And if you look at real estate in general, other than the bubble that we had from, pretty much '08 to 2010, real estate has been a really, really, really strong investment and something that really has never hurt anybody that I've ever worked with. Now, yeah, if you buy and sell in a 6-month time frame, could it be the wrong 6 months? Of course. But if you're buying property, whether it's a primary residence, second home, rental, and it's typically a moderate to long-term hold, you're typically going to do very, very well with that. And we're not even talking about the tax benefits and all those other things that go with it, but just in terms of what the value of the home's going to do and how it's going to overall affect things financially for you, it's typically always worked out pretty well. Rate wise today, it feels really bad. People don't like where rates are. It's not as accentuated as it was a couple years ago. Primarily just because we've been in this rate environment for 3 years. So people are just a little bit more used to it. When rates first went up, I mean, it was investors, homeowners, first-time home buyers. It didn't matter. I mean, it was massive sticker shock. They just didn't understand that kind of a rate environment. And, going back in time and looking at what happened, we had been in a very, very Fed-friendly rate environment in terms of how the Fed dealt with mortgages pretty much since 2009, 2010. So we had pretty much almost 15 years where there was some sort of involvement by the Federal Reserve on rate manipulation. And we got really spoiled. And obviously we got really, really spoiled when COVID hit and they kept rates. I mean, you could buy an investment property at 3.25% to 3.5% interest rate. It was crazy, right? So, taking people off of that addiction of really low rates was tough, but I promise you, there's been plenty of activity, plenty of purchasing, plenty of investors buying investment properties. They just have to look at it differently. They just have to run the way that they run their calculations differently, whether it's a cash on cash calculation or, whatever they're doing with a commercial property or residential. They really just need to focus on what their long-term prospect is for that particular property. Like I said, we had probably a 6 to 12 month lull of investors like just exiting the market. So people buying rental properties just kind of quit. But they soon realized, hey, if I would have bought this house a year ago, I might be negative cash flow a little bit, but I'd be $30, $40, $50,000 richer in equity. And so they started realizing that there was still some good value in being a landlord and growing their portfolio and buying stuff. And so, overall rate wise, it affected things. Yes, rates are a little bit high. That's really not the focus we like to put a lot of focus on. I do think rates will cycle. So as far as like projection goes, rates will eventually cycle. They always do. Now they might go up more first but then come back down, but you'll see rates ebb and flow. The Fed, speaking of the Fed, they just met, they ended their meeting yesterday, their 2-day meeting here in July. And they, there was a 50 to 75% chance within the market that they were going to, lower rates again. And they didn't do that. And mainly it's just because the economy still seems to be pretty resilient. The amount of growth that they're seeing, the GDP they're seeing, they just don't feel like they should lower rates right now. Now that's the Fed rate. One of the things to make a really unique distinction that I always like to bring up when we talk about mortgage rates and the Fed and how they all are intertwined. When the Fed lowers rates, they do not lower mortgage rates. So it's a lot of people, like I'll get a phone call, Dan, the Fed just dropped rates 0.5%. Does that mean I can, rates on mortgages went down 0.5%? That is not how it works. The Fed controls the Fed funds rate, which then in turn drives the prime interest rate, which is very much involved in consumer lending of like car loans, credit cards, lines of credit, those types of products. But the actual mortgage market is a market just like the stock market. There's a bond market out there, and that's where mortgages run through. So the Fed playing with interest rates, that more just signals the market which way they think rates should go. It's more of okay, this is what the Fed's seeing, the numbers are seeing, maybe there's less inflation, more inflation, we should, adjust accordingly, and then the market will make adjustments for it. But always good to remember that the Fed doesn't control mortgage rates.
I think that's a great summary of where we're at today. I mean, you do both retail or residential and commercial. Now, when it comes to like physicians, there's some probably younger doctors or people, moving, or they want to buy a new home. And what I hear often from our community is home prices are still really high and rates are high. So what I can afford doesn't seem, reachable or affordable. I mean, it seems like I can't afford too much out there. Like, how do you coach people through that when they come to you and say, hey, it just feels like home prices are so high, rates are so high, I can't afford very much out there? What do you say to them?
I pretty much, you ask the question, do they want to rent forever? I mean, there's two different people in that scenario. Do they own a house currently, or are they not owning a home? So the ones that own a home currently that are looking to do a move up home, they're a little bit harder to, walk through because they probably have a 3% interest rate on their current home. Yeah. And they don't want the sticker shock of selling that house and going to buy another one. Again, rolling back when rates were low versus now, life goes on. We had a lot of people pause and say they don't want to buy and they wanted rates to come down before they bought. Well, jobs change, marriages, you move, you relocate, you have kids, you start families, you do stuff. Things just change. One of the things that doesn't ever seem to change is that home prices go up. Now, right now we're seeing in the market maybe a little bit of softening in some areas where you're seeing the market, it's not really correcting, but you're seeing things where, inventory is growing a little bit, but we're still seeing I'm still seeing multiple offers on properties. I'm still seeing fights for properties. Yes, some sit, but overall values of real estate seem to still be going up. So the question or the response to them is like, hey, that's fine. If you don't buy now, if rates are still that you're going to have to rent or live somewhere and pay that payment, which gives you zero tax deduction, zero benefit. And if you want to go buy the same house in a year, you could very well pay 30, 40, 50, $75,000 for the same house. And it's much easier. And we've time and time done this, even in this environment. We've seen rates fluctuate anywhere from 0.75% to 1% over the last year. And so people that bought a home at 7.5, I mean, rates aren't phenomenal right now, but they're still 6.5. So they can go in and refinance and they've got their house. And now it's a matter of just managing the debt. Now it's a matter of, okay, I bought the house, got it a year ago, I'm good. But see, when rates come down and everybody floods the market, you're going to have all the same problems you did, 2-3 years ago, which you're going to see a massive influx of people that are sitting on the fence that now to say, hey, I want to go buy. And you're going to see that inventory get sucked up. And then all of a sudden it's going to be the same old thing of multiple offers, people fighting for houses and prices getting pushed up again. So it's much easier in the environment we're in to buy right now. You have a bigger selection of homes. It's easier to negotiate with the seller. You are in control as a buyer. Doesn't mean the seller is not in control of what they're selling and their price, but instead of them sticking a sign in the ground and knowing it's going to sell in 3 days with multiple offers, they know they have to strategically do it. It's got to be priced properly, and they're looking for good buyers out there. And so we've really actually seen in the last few months, quite a bit of an uptick in just activity in general, and it's mainly primary residence purchases. We've always seen investment properties, but like I said, life goes on, and we're seeing a lot more investment. Primary residence people starting to say, okay, I need to make a move. I got to do something.
I mean, do you find that most people are going with like a 30-year fixed loan, or are they doing kind of the shorter ARMs, adjustable rate mortgages?
ARMs are finally coming back into play a little bit. Traditionally, it's all been 30-year fixed mortgages just because we were in an inverted yield curve, which all that means is that the long-term outlook of rates and the short-term outlook of rates was reversed. So ARM rates were functioning at the same rate or higher as a fixed rate. So then you just defaulted to a fixed rate loan. We're now finally seeing the ARM market in the last 6 months actually start to function a little bit more normal, where doing a 10-year, a 7-year, or a 5-year ARM might be a benefit. In a traditional market, a 7-year ARM should be about 0.75% lower than, on average, than a 30-year fixed. Right now, it's 0.25% to 0.38% lower. So it turns into a conversation of value. Does the person getting the loan feel like that's enough of a value to take an ARM versus a fixed rate loan? As the market normalizes, you'll see that spread widen, and then you'll see ARM products be more and more common in terms of closings. We've probably closed in the hundreds of loans we close a year. I think last year maybe we closed like 1 or 2 ARMs, like literally like 1 or 2. That's it. Typically it's an asked for product. And it's a matter of finding timing, depending on what the market's doing. It could just be the right timing where it's 0.5% lower and it makes sense. And so they do it. But most of the time right now it's fixed rate loans.
I mean, do you think that people are thinking, hey, if interest rates are going to come down, it's better to get into one of these, adjustable rate mortgages, shorter term loans, because I'm probably going to refi anyways? Is that what you're saying?
Yeah. And that's where, again, it's a matter of, does the person getting the loan feel that whatever term, if they get a 7-year ARM, are they going to more than likely be doing something in the next 7 years, whether it's a refinance or a move to another house or whatnot? That's turns into the question. Most loans, if you go backwards in time, all the way into the 80s, people don't keep loans for more than 6. The loans that were issued during COVID will probably be kept longer, so that'll tweak the numbers. But the average is between 5 and 6 years is the longest really anybody kept a loan, mainly because they'd move or refinance for whatever reasons. And so a 30-year fixed loan, they're not paid down for 30 years. You don't see that typically.
So buying a home isn't just a transaction, it's a transition. I think we all know that. It's a new chapter for your life and your financial future. But let's be honest, getting a mortgage can sometimes feel impersonal, confusing, and stressful. I definitely know this, and that's why I want to tell you about Movement Mortgage.
Now, they were founded during the 2008 financial crisis, not to repeat the old way of doing things, but to build something better, like a faster, more transparent mortgage process rooted in real human connection. So whether you're buying, refinancing, or just exploring your options, Movement makes it simple to plan ahead. Their site offers free tools to estimate payments, explore home budgets, and understand refinancing all before you speak to anyone. So when you're ready, their 10-step loan process keeps you informed every step of the way. Now, what really sets them apart is that Movement reinvests a portion of their profits into underserved communities, funding schools, housing, and healthcare projects both in the US and globally. So if you're thinking about a move or just want to know your options, visit movement.com. That's movement.com. What if you could catch PIMD Con, the Physician Real Estate and Entrepreneurship Conference, without booking a flight? The PIMD Con 2025 virtual ticket lets you join live from anywhere. Grab your friends, your team, or colleagues, and experience the event together from wherever you are. You'll earn CME, watch every featured session via live stream, and get lifetime access to the recording so you can rewatch anytime. You'll also get access to our vetted sponsors and partners online. So if you decide to act on an idea, you know exactly who can help you put it into practice. Now, after the conference, we're going to keep it going with PIMD Con Encore Nights, where I'll host small group breakouts, live speaker Q&As, and targeted networking, all done virtually. So bring your questions, get real-time feedback, and leave with a plan you feel good about. And here's the fun part. You don't have to experience it all alone. Now, invite your friends, your team, or colleagues to join you online and save up to 50% with group ticket discounts. Now, we've packed this year's agenda, and I couldn't be more excited. So if travel's not in the cards for you, I get it, but I still want you there. The virtual ticket really is the next best thing to being in the room. So grab your virtual ticket at PIMDcon.com. That's PIMDCON.com. See you online. Now back to the show. Are there any mistakes that maybe you see doctors get themselves into?
They're, when they buy their own, whether it's primary or I guess it depends. So are you saying on their primary residence when they buy their primary residence?
Is there anything that maybe they're making decisions on the outside, on the financing? Because I'll be honest with you, that point is really scary. When you're a doctor, you're signing on this big loan, and you're just for a while, you're like, I hope I'm making the right decision.
Yeah, I was just gonna say that most physician loans or doctor loans, they're bigger loans, right? They're jumbo loans. They're not buying a $200,000 rental in Indiana. They're buying a $2 million, $3 million house. Mm-hmm. I think the biggest thing that they need to look at, when they're signing that loan is making sure they structure it right. I get estimates all the time. I'll get somebody walk through the door, whether it's a physician or a regular, a guy that works at Microsoft, for example, or Amazon, and they're buying a $2 or $3 million house. And if they don't understand what kind of loan they're getting, they might end up paying. Typically, this thing I see is a bunch of extra closing costs that they shouldn't be paying. So they're paying a lot of money, or they get because it's a big loan, they get a false sense that they need to buy the rate down and do a permanent buy down. Permanent buy downs, to understand what that means, is that's where you're paying upfront money to drive the interest rate lower for the life of the loan. Okay, those typically have on average a 4 to 5 year payback period, meaning that they don't even they save money day one, but the money that they invested in the loan doesn't actually even get recovered until they're in year 4 or 5. And so, but they are doing it because on their loan being so big, driving the rate down makes a big difference monthly payment wise. So they feel that, effect right away, but it's still not worth it. It's typically not. So if we have somebody that is buying a big loan, that's, buying a house that's really large, that has a big loan, we will oftentimes do like a short-term buy down for them. If they really want to try to encapsulate a lower payment for a year or two. A short-term buy down is where you don't do a permanent buy down. You just do it for a short-term amount of time. It's typically, the most common is what's called a 2-1 buy down, where you drive the rate lower in the first year that you own the home by 2 percentage points. And then in the second year, it's 1 percentage point. And then in year number 3, it indexes to the full rate that you originally were supposed to close at. But what's nice about that is most physicians specifically, they can track and see where their income's going to go. And so they typically will know, hey, that gives me the leg up I need. And then in a year or 2 years, I'll be making more money. It takes that pain away. Plus what's nice about it is, and the biggest benefit of a short-term buy down, so a permanent buy down, that money's gone. When you go to closing and pay all this money for those closing costs, If rates fall flat on their face in 6 months and you call and say, hey, Dan, I want to refinance, we can refinance, but all that money you paid on that loan on that permanent buy down is gone. That was on that loan. It's absorbed. A short-term buy down, a 2-1 buy down is considered a prepaid. And so that money that is unused. So in the scenario I just did, if you do 6 months later, rates fall down and you did a 2-1 buy down and you're still in that first 12-month period where your rate's 2 percentage points lower, you can still go in and refinance and take advantage of the lower interest rate. And then the unused portion of the buy down that wasn't used yet. So the last 6 months of the first year, and then the entire buy down for that second year, that's refunded back to you. And so a lot of these more expensive homes that doctors buy, let's just be, that's a home that does not have as large of a buyer pool. So those homes typically are easier to negotiate. So a lot of the contracts we're getting that are on bigger homes right now, they are negotiating with the seller to pay those buy downs is what they're doing. So,
I didn't know that was a possibility. Wow.
Yeah. It's 2-1 buy downs on jumbo loans really weren't a thing up until about 6 months to a year ago. We were able to work with some of our investors and get them. So jumbo loans are portfolio loans. They aren't like a Fannie Mae or Freddie Mac security or an FHA loan or a VA government loan. Those are your mass-produced loans that you can do buy downs on, and that system is all set up. Once you go and bleed into that jumbo territory and you start doing these larger loans, buy downs aren't as common. And it's not because they don't want to be done; it's because investors, the servicers of those loans, they didn't want to do it. So we have multiple of them that do it. So we've been utilizing that feature a lot.
What should people be asking? Because some people don't even know it's a possibility. So should somebody, when they're looking for a loan, I mean, most people are just thinking the standard, should they be asking their lender, hey, are there any other options to get creative around these kind of things? Is that simply how they should ask?
100%. Yeah, they absolutely should. So, anybody that's walking into any transaction, regardless of price, if there's not really a loan that we do for a primary residence where they're worried about their payment. I mean, they're looking at it, rates are higher. They actually come down a little bit, but they're still over 6%. And it stresses them out. And so absolutely during the pre-approval process, not when they're making the offer. That's typically not that you don't want to bring it up then, but it should be part of that front end process where you're going through the pre-approval and bringing these things up and saying, hey, you can do this stuff, so that they know that when they go into making into a situation where they're making an offer, they can then, tweak that offer and do things to it to try to make it fit their needs. But yeah, they should absolutely be doing that. They should also be looking at ARMs. Like I said, there's some jumbo ARMs out there, that depending on down payment, if they're doing a very large down payment, ARM rates can start to get really beneficial. You cannot do, just to clarify, a 2-1 buy down on an ARM.
Right.
You can't do that. So you can only do that on a fixed rate loan. But they should be looking at all those options, just to make sure that they understand what they are, because, really anybody, when they're out looking for a house as a primary residence, there's a few where it's like, hey, you're approved to this amount and that's it. Most people are looking in a range, could be 800 to $1 million. Well, if they buy an $800,000 house and they find one they like at $800,000, their view of that mortgage payment is going to be different than if they end up finding the one for $950 or $1 million. It doesn't mean they can't afford both of them, but obviously there's budgetary constraints and stuff like that. So knowing what is out there and what they can do, so that they can structure an offer right, depending on where they're at, is important.
That's great advice. I want to touch on the commercial side real quick. And by commercial, I'm really referring to more like investment properties. For the physicians that, are part of our community, a lot of them are involved in purchasing their own real estate and really going in towards investment properties. What's that market look like today for those loans, and where do you think that's headed?
So the commercial real estate market is doing well. It's fine. I mean, it again as well kind of slowed way down, because commercial properties are really underwritten to the property, not to anything residential is really underwritten to the borrower. Commercial looks at the borrower, but they really are looking at the business, and the business is the property. So they're looking at cash flow calculations and all that stuff to make sure that the business is essentially or the commercial property is self-sustaining. And so what ends up happening in most commercial properties, now the market's adjusted a little bit to balance itself. But the biggest issue is just what's the down payment going to be? Because you've got to typically get that commercial property cash flowing. And so if it's residential commercial, like an apartment building, if it's been updated and run well and they've gone in and brought it to market rents, that number's a little bit easier to get to because they're actually renting it for current market and they're getting that cash flow. If it's an older building that hasn't been updated and the renters are all in there are, 5, 6, 7, 10 years old, and the seller is, what we're seeing a lot right now is that sellers of commercial real estate, they're people that are phasing out. So they are people that are older and have owned these properties, or they've been gifted to them, or they've been in the family, and they're just wanting to exit that piece of their portfolio. And so great and all, but the problem is they want fair market value for the property, but yet they haven't done anything to the property or raised rents for the last 5, 7 years because they like all their tenants and they don't owe any money on the property. So they aren't as in tune with, they don't want the cycle of tenants. They're just happy with the way things are. And so we can go in and look at what pull like AirDNA and see what they should rent for and try to calculate that into things. But commercial, again, strong, but a lot of commercial property gets overlooked or bypassed just because the down payment's really high. And so it just depends on if they want to put that many eggs in one basket. A lot of the commercial stuff we've been doing has actually been rehab related. So people are buying these distressed properties. They're getting more hard money style loans on them with construction money built into them. And then they're rehabbing them slowly and over the next 6 to 12 months. And then they come back after they've rehabbed them, raise the rents, and then they go in and refinance it. And it typically works out much better that way.
So on the commercial side, when people are looking for these loans, again, just so that people understand what this looks like is, how can they make sure, since this is, mostly based on the property itself, how can they make sure they're in the best situation to make sure they get the most favorable outcome for themselves in terms of a loan?
Buy a property that's been well managed. So on the commercial side, so when you go into a commercial offer, any commercial lender is going to say, I need everything. That they want all the stuff on the property. And the listing agent of the property, if they have done their due diligence, they are going to literally have an entire packet already established and ready that is going to be potentially up to 100 pages thick of just everything about the property, the cash flows, everything, the leases, all the stuff. And then that's what they're going to need to determine how good and viable the property is. And that's what the lender needs to determine what kind of loan that they will do. Now, a lot of properties, depending on where they're located, how long the sellers owned it, are they self-managing? Do they have a property manager? Records aren't good. They're not as, things aren't as tidy as they could be. And that just makes it harder. It doesn't mean you can't get a loan. So just like with residential real estate, commercial, when I go to do a commercial loan in Atlanta, Georgia, on an apartment building, I'm going to search and there's going to be 8, 10 lenders with varying terms, all A paper, that are going to say, we'll do that. We'll do a loan in that market on this price. This is the rate. But every single lender is going to have different underwriting guidelines, a little bit different of a tweak. The rates are going to be different. Terms are going to be a little bit different. And so it doesn't mean that you can't get the loan done, but it just means that you might not be able to get the best terms because you might need to go to a lender that's going to overlook some stuff, or it doesn't care as much about that. So the one thing about commercial lending that it is often forgot is that commercial lending is very regional. So if you go find and search commercial banks to do loans like on apartment buildings, you're not going to see the big banks advertising that, like B of A, Wells Fargo, Chase, US Bank. You're going to find that smaller, mid-sized regional bank. That is their bread and butter, is that smaller end commercial market. What I mean by smaller end commercial market is loans less than 10 million. Yeah. B of A is going to lend on a skyscraper at 200 million, but those residential properties, they're typically going through regional lenders. So when I go to Atlanta, Georgia, and let's use that example, I'm not getting the same lenders that are going to do a loan in Sacramento, in California, or in Bend, Oregon. They're all going to be different lenders. And they're all going to be regionally based. Now, there are some lenders that'll go national or they'll lend in 35 states or whatnot. But typically your best terms are those smaller regional banks that, and you want to appeal to them. And it's old school. I mean, it's there. You're literally submitting everything to them, and there's not an automated system underwriting these files. It's actual, individuals, people at the bank. There's loan committees that they go to. They talk about it. They make adjustments, changes. It's just the way that environment works. So typically a well-managed property is the biggest thing to look for. And again, that's regardless of age of the property, just so that it has all the data and everything.
Got it. I mean, there's so much to spend. I mean, you could probably spend hours on this stuff, and obviously you love the space, and obviously so many people here, listening to this have actually, been through this process, at least for their own homes, but a lot of them are looking into buying rental properties as well. Is there anything that you found today that might be a little creative that people that, all these physicians that you've helped buy, commercial properties, rental properties that they've used that has been really good for these days in terms of trying to get good financing for these properties?
Yeah. I mean, a lot of when I work with when I first get a physician to come through the door and they say, hey, I want to get involved in investing in real estate, what is very, very common is they probably have a primary residence because they need somewhere to live. They probably have more than 50% equity in their primary residence. A lot of times, if they're a higher income earner, they have a ton of cash and very little investments anywhere else. So they literally walk through the door and they're completely deleveraged, and they're busy. Physicians are busy. Physicians are working 60, 70 hours a week. I've talked to numerous newer physicians, whether they're in their residency or they're just getting out of college. There is no classes on finances that they are given or taught before they exit and move into the real world. They walk out of school and they got a $250,000 signing bonus and a $250,000 a year salary. And they've been living on $40,000 a year as a residency, and they've been poor. And so they just don't know how to manage it. And so what happens is they get busy with life, and that money just builds up and accumulates, and it doesn't do anything. They're not getting a return on anything. So they're very deleveraged. And so the biggest thing that we typically work on with a physician in the new space is getting them to understand leverage, working with it, getting them lined up with a CPA to make sure that they understand how this can work. As you know, there's a ton of tax strategies right now that can be used if they want to buy properties, but essentially showing them how they can utilize their cash and their equity in their current property to safely go out and buy real estate without creating a lot of extra risk. And there's risk in anything, but you can't leverage and make money and do stuff if you're not going to take a little bit of risk somewhere. And so it's showing them how to do that. Once they realize it and they see it and they understand how it works, they're usually calling us like every 2 or 3 years because they want more money, more cash out, right? For down payments. But that's the biggest thing we see, is they just don't have that leverage piece understood. And we just try to teach them that, go through that with them. Hopefully they have, again, people in your community or other people they're talking to that they're working through understanding this, in that aspect of things. The other thing is that, for commercial property, making sure that, again, they look at the property itself, but they still need to run themselves very healthy. So I've had it's very common. I'll see an investor, they start out in the residential space and then they want to move to the commercial space, and they're just they're too leveraged. So then they're like, okay, I got to sell a couple properties, do a 1031 again, because it reverts into that large down payment issue, and they don't have it and they have nowhere to grab it from. The other thing is just understanding if they do have investments, understanding the tools that the investments can give them, understanding margin accounts, S blocks, I blocks, sorry, I'm using acronyms, securities backed lines of credit, and the insurance backed line of credit. Those are your S blocks, your I blocks. Those are tools that you can utilize to grab cash quick, to be able to make moves and things like that within real estate, which again, as you're moving through, whether it's residential or commercial, after you become an investor, your hardest thing to find is going to be cash, because you're always going to have your money deployed. And if it's not deployed, the second you get it, you're going to deploy it. And so usually people are trying to find ways to finance things and to do stuff. And so just making sure they have all those pieces set up so that they can take advantage of opportunities when they come around.
Well, it's been great advice. It's a lot of great wisdom. I know there's things that are probably said in here that I don't understand yet. And I'm excited to unpack those with you in the future talks. Just to leave people with any sort of final advice for anybody who's trying to navigate today's interest rate market overall and get into the real estate game. Simple final advice for them.
Yeah. Don't be scared to get in the market. Don't be scared to stay in the market. Time goes forward. Everything seems to, everybody that comes in today wishes they would have stayed in the market 2 years ago. We had a lot of people pause, and now they're coming back and they're reactivating, because now they're like, oh, it's fine. Like because they got, not that they got scared, but they got worried about the economy. You know, it could be political stuff. Obviously, there's stuff going on in the world that not everybody loves with other countries and all that kind of thing. So that uncertainty causes people to pull back. Rates right now, believe it or not, if you look historically, they're not high. They're not, right? My dad was in lending back in the 70s. He remembers issuing someone 21.5% on their loan. So rates, while they feel high, they're not that high. They will cycle. Rates will eventually come down. They might go up. They could get higher. You just never know. But the one thing that's tried and true is real estate always, if it's held long term and its data is there, you can go pull it. Is there moments in time where it hurts to, it's not perfect, of course, but there's not a investor that I know that started buying houses in 1997 that is not way more better off today from a net worth standpoint, whether it was commercial or residential, than they were 25 years ago. I mean, I'm going to give you one quick story. I remember a guy in 2012, he worked at Microsoft, and he came to me and just referred to me, and he went and decided, now this is 2012, so the market had just started to get a little bit better, right? It was getting a little bit healthier, and he decided to go buy, and he went and bought. So at that time, because of the loan products that were out there, really the maximum number of finance properties you could have was 10. That was back then, not today. So he went out and bought 10 rental properties, and he retired in his early 50s in 2018. And I think he still owns all of them. And I think, I don't even want to, because he was buying properties that are worth $1 million today for like $150,000. I mean, it was crazy. So that's an extreme story, but obviously one where, he just had faith in what he was doing and knew it was a decent time to go purchase. And I just think that that's something that, right now is a good time. I haven't had anybody come to me saying I shouldn't, that bought a year ago, 2 years ago, that says I shouldn't have done that. They're all either trying to buy another piece of property or do something else or pivot, because the power of what they've purchased in the past is coming through to them now.
Awesome. I love the advice. Thanks for sharing your time and your wisdom with us. If somebody wants to connect with you in some way, where's the best place to do that?
Real easy. My website, www.danpeckteam. So DANPECKTEAM.com. My cell phone number is, believe it or not, one of the easiest ways to get out to me as well. 206-660-6241. And that's the two best ways. They can literally email me from my website. My whole staff's on there. They can grab it. It's really, really simple.
Awesome. Well, again, thanks for your time. It's been an enlightening.
Peter, it was great. I really appreciate you having me, and look forward to doing it again.
Okay. Talk soon. Thanks.
Yep. Take care.
Enjoy the show? Let me know by dropping a review in the podcast app you're listening to us in. And if you haven't already, make sure to hit subscribe. Join thousands of physicians who are also on this journey to creating their ideal lives through multiple streams of income. Learn more at our website, passiveincomemd.com. Thanks again for allowing me to be a part of your journey. See you next time.